Hello everyone and welcome to this training course. If you're a loan officer or real estate agent and you still don't understand FHA financing, you are losing clients and money. FHA isn't just another loan program. It's the gateway to serving more families and more people who never thought home ownership was possible. By the end of this training, you'll know exactly how to guide clients through the FHA process with confidence, clarity, and zero guesswork. You'll understand the advantages, the strategy, and the opportunities that most agents and MLOs completely overlook. This is how you expand your reach and close more deals. As a quick reminder, don't forget to download a copy of this presentation from my training website so you can print it, study it, and make notes. The link to the training website is on the screen and in the video description. And if you enjoyed this training, be sure to subscribe, like, and comment. Your feedback helps us grow and reach more agents like you. An FHA mortgage is a home loan insured by the Federal Housing Administration, a division of the U.S. Department of Housing and Urban Development. This government backing reduces risk for lenders, allowing them to offer more flexible qualification criteria. Essentially, FHA loans are designed to make home ownership accessible to a wider range of borrowers, particularly those who might not qualify for conventional financing due to lower credit scores or limited down payment funds. FHA loans offer several compelling advantages. First, the low down payment requirement of just 3.5% makes home ownership attainable for many. They also provide flexible credit guidelines, often more forgiving of past financial issues, and even allow for manual underwriting. Borrowers can benefit from higher debt-to-income ratios, and gift funds are fully welcome for down payment and closing costs. Plus, FHA supports multi-unit property purchases and offers assumable loans, a significant benefit in today's market. One of the most significant benefits of FHA financing is the low down payment. With a FICO score of 580 or higher, borrowers can secure a home with just 3.5% down. This is a substantial difference compared to conventional loans, which typically require 5% or even 10% down. This lower entry barrier makes homeownership a reality for many first-time buyers or those with limited savings, directly impacting affordability in Southern California. While FHA loans offer great flexibility, they do come with mortgage insurance, known as MIP. This is the trade-off for the more lenient guidelines. There are two components: an upfront mortgage insurance premium, which is typically financed into the loan, and an annual mortgage insurance premium paid monthly. It's important to explain to clients that this insurance protects the lender in case of default, enabling FHA to offer these accessible loan terms. It's essential to be transparent about FHA's limitations. First, the annual mortgage insurance typically remains for the life of the loan unless specific conditions are met. Second, FHA has strict property standards requiring homes to meet HUD's minimum property requirements, which can lead to appraisal conditions. Third, FHA loans have county-specific limits, which can be lower than conventional high-balance limits. Finally, FHA loans are strictly for owner-occupied primary residences, not investment properties. FHA is known for its credit flexibility. While a 580 FICO score is generally needed for the 3.5% down payment, FHA can be more forgiving of past credit issues than conventional loans. They also allow for manual underwriting, which is invaluable for borrowers with unique financial situations, such as self-employed individuals or those rebuilding credit. This flexibility opens doors for many who might otherwise be excluded from homeownership. FHA offers more generous debt-to-income, or DTI ratios compared to conventional programs. This is particularly beneficial in high-cost areas like Southern California, where housing payments can be substantial relative to income. Automated approvals can go up to 56.9% DTI, and manual underwriting allows for even higher ratios with compensating factors. This flexibility helps more borrowers qualify, even with existing debts. A major advantage of FHA loans is the allowance for 100% of the down payment and closing costs to come from gift funds. This means family members, employers, or even approved nonprofits can contribute the entire amount. Proper documentation, including a gift letter stating no repayment is expected, is crucial. This feature is a game changer for many first-time buyers who have strong income but limited savings. FHA loans are specifically for owner-occupied primary residences. This means the borrower must intend to live in the home as their main residence. They are required to move into the property within 60 days of closing and maintain it as their primary residence for at least 1 year. This rule ensures that FHA programs are supporting homeownership for individuals and families, not speculative investment. FHA financing is an excellent option for purchasing multi-unit properties, from duplexes to fourplexes, with just 3.5% down. This enables a strategy known as house hacking, where the borrower lives in one unit and rents out the others. The rental income from the other units can significantly offset the mortgage payment, making homeownership more affordable and building equity faster. For triplexes and fourplexes, FHA requires a self-sufficiency test. This means that 75% of the market rents from all units must be sufficient to cover the property's total PIT payment: principal, interest, taxes, and insurance. The appraiser determines market rents, and if the 75% threshold isn't met, the loan cannot be approved. This ensures the property can financially support itself. Rental income from non-owner occupied units can be a powerful tool for qualification. Lenders will typically use 75% of the market rent, as determined by the appraiser, to account for potential vacancies and maintenance. This income can significantly offset the property's debt obligations, making it easier for borrowers to qualify for larger loans, especially in Southern California, where property values are high. FHA has specific property standards to ensure the home is safe, sound, and secure. Common issues that can arise during an FHA appraisal in Southern California include peeling paint, missing handrails, roof problems, unstrapped water heaters, lack of safety detectors, and exposed wiring. These issues must be addressed before closing, so it's vital for agents to understand these requirements up front. Before an FHA appraisal can be ordered, a case number must be obtained from FHA. This unique number is tied to the property and the borrower, following the loan throughout the entire process. It's requested through FHA Connection, the official portal for lenders. Understanding this step is crucial for loan officers to initiate the appraisal process correctly and keep the loan timeline on track. The FHA Amendatory clause is a mandatory document that protects FHA buyers. It states that if the property appraises for less than the purchase price, the buyer is not obligated to complete the purchase and is entitled to a refund of their earnest money. This clause cannot be waived even in competitive markets where buyers might waive appraisal contingencies for conventional loans. It's a critical point for agents and buyers to understand. When comparing FHA and conventional loans, each has distinct strengths. FHA excels with lower down payments, more flexible credit guidelines, and higher DTI allowances. Conventional loans, on the other hand, offer the advantage of private mortgage insurance eventually dropping off, more flexible property standards, and higher loan limits. Choosing the right loan depends entirely on the borrower's specific financial situation and property type. FHA loans are ideal for several borrower profiles. They are perfect for first-time buyers with limited savings, or those building credit. Borrowers with FICO scores between 580 and 680 often find FHA more affordable than conventional. High DTI borrowers, multi-unit buyers looking to house hack, and those receiving 100% gift funds are also excellent candidates. Additionally, clients with limited reserves beyond their down payment can benefit. Conversely, conventional loans are often a better fit for borrowers with strong credit and a 5% or greater down payment, as they can avoid the lifetime mortgage insurance of FHA. If a property is a fixer-upper that won't meet FHA's strict property standards, conventional financing offers more flexibility. Also, if a client is interested in a condominium that isn't FHA approved, a conventional loan is the only option. The FHA Streamline Refinance is a fantastic option for existing FHA borrowers looking to lower their interest rate and monthly payment with minimal hassle. It typically requires no appraisal, no income documentation, and no credit score check. The borrower must have made at least 6 payments on their current FHA loan and demonstrate a net tangible benefit, meaning the new payment must be meaningfully lower. FHA requires stable income for at least 2 years, typically verified with W-2s and tax returns. Self-employed borrowers may need more detailed analysis. A unique FHA advantage is allowing non-occupant co-borrowers. This means a family member who won't live in the home can be added to the loan to strengthen the income and credit profile, helping buyers qualify who might not otherwise meet income requirements. FHA's asset requirements are generally more flexible, making home ownership accessible for those with limited savings. Down payment sources can include gifts, grants, or personal funds. While FHA doesn't always require extensive reserves, having some funds beyond closing costs is always advisable. The focus is on ensuring the borrower has sufficient funds for the down payment and closing costs, often through flexible sources. To excel with FHA, position yourself as the expert. Master the guidelines and nuances to become a go-to resource. Educate your real estate partners through training sessions, helping them understand FHA's benefits and limitations. Screen properties early for FHA eligibility to avoid surprises. Finally, build strong partnerships with down payment assistance programs to offer even more solutions to your clients. FHA loan limits are set annually by HUD and vary by county. Southern California counties are typically classified as high-cost areas, meaning they have higher FHA limits. It's crucial to check the specific limits for each county when taking an application, as these limits increase for multi-unit properties. Staying updated on these limits, which can change quarterly, is essential for accurate client guidance. Becoming an FHA expert involves continuous learning and strategic application. Master the intricate details of FHA guidelines. Train your referral partners, empowering them to identify FHA-eligible clients and properties. Build efficient systems for processing FHA loans. By doing so, you can identify your niche and effectively serve Southern California's diverse buyer population, making FHA financing a powerful tool in your arsenal. As a final reminder, don't forget to download a copy of this presentation from my training website so you can print it, study it, and make notes. The link to the training website is on the screen and in the video description. Until next time, thank you for watching and don't forget to subscribe and share.